The government shutdown is over, at least for now, and food delivery company Postmates taking the opportunity to file for an IPO. Nabila Ahmed, Bloomberg Deals reporter, joins us now. Nabila, great to have you with us. Talk to me about the thirst to come public and the rush for 2019.
Jonathan, Postmates, as you know, was the pioneer in this market, and it's really going to test the market for these app-driven delivery companies. Postmates, obviously popularized by celebrities like Serena Williams. They're sort of got more of a wealthier clientele. Their prices are higher as well. They're looking for a valuation of $1.85 billion or higher. They said they said this week that they filed confidentially for that IPO. They've hired JP Morgan and Bank of America to run that process. This company just raised $100 million in January, so the valuation is pitched at that level. They've got a few options for growth that they've talked about. What's little known is that they're actually the main delivery company for Apple and Walmart as well. So if your computer breaks down, that's who can deliver you a new laptop, for example, at home. But as you say, the shutdown has really tested the market for IPOs. January was basically a wash. And so these companies are coming to market now, trying to get into this little window before we perhaps go into another shutdown next week. So Postmates coming up $1.85 billion or more. Jonathan,
Nabila, thank you very much. Santosh Rao joining us now, Manhattan Venture Partners Head of Research. Still with us, Keith Parker of UBS. Santosh, was reading your latest research piece about this particular segment of the market. Talk to me about the size and the potential for more growth right here.
Absolutely. This is a very big market and still in a very early stage. I think it's over 500 billion, the total restaurant business, and these online delivery is probably 10% or less than the overall.
That's amazing that the traditional way of delivering food and ordering it is still 90% of the overall market.
Yes. And so there's a lot more to capture here. So this is still early. The growing urbanization is what's causing all this. People are used to ordering everything. It's all on demand now. So I think this thing plays right into that. And it's great. It's a great service. People love it, and millennials love it. And that's a growing segment of the market.
We've been waiting for a lot of these companies to come to market. A lot of these companies have waited a whole lot longer than typically on average they usually would. Why are these companies so much more mature now as they come to market, say to how old they were 10 years ago?
Yeah, I think what's happening is, like you said, they're 8 to 9 years on average, and they've done 8 to 9 rounds of equity funding. So that's the sweet spot. That's when you want to get out for the next leg up, which is more growth. You need to acquire, you need a public currency, you need to hold on to talent. So I think these companies are now ready. Their business models have been tested. The revenues are growing very well. So they're much better, much mature, with good backers behind them. So they've been well tested.
One thing you guys do is actually facilitate private transactions, private market transactions. How important do you think the secondary private market has been to keeping these companies private?
Absolutely. A big part of that is secondary markets. We keep just the flow going. We keep it liquid, and there is a big need for this. I think we filled a very good gap in the whole process of going to an IPO. So I think it plays a very big role, and increasingly so since the last few years.
Well, the rush to go public is building. Bloomberg's Taylor Riggs taking a look at what could be a big calendar for IPOs in 2019, Taylor.
Well, we're hoping, but so far the story is there haven't been any, in part because of the U.S. shutdown like you were talking about. And there's a few different stories going on here. On the global front, you had the massive Q4 volatility in the rout of the equity markets back down in December, which means that non-U.S. companies are down so far in 2019, both in terms of the number of deals and the volume. And then on the more domestic front, of course, the U.S. government shutdown means you have a slew of companies sort of waiting up to get their SEC review, but so far not being able to actually come to market. And so you have the number of deals and the volume down for the domestic front as well. The story doesn't look that much better either when we have a long-term chart. When we look at 2019, and I know it's early days, so I caution that, but you are down relative on both the number and the volume, even going back to the route of 2008, 2009. You have within the U.S. only $1.8 billion so far, or 9 issuers. That is lower than even 2009 when you had $16 billion worth of deals, or 51 issuers. The big ones we're waiting for: Lyft, Uber, and Airbnb. John?
And hopefully we don't get another government shutdown and the whole thing has to shut down again. Taylor, thank you. Keith Parker, some people screaming at the screen right now, I'm sure, saying this is the top. This is the toppy kind of behavior you expect when the big companies in the private markets come out for an IPO and look for an exit. What do you think?
Yeah, we have seen that historically, but I also think at the end of a cycle, you're usually trading at much higher valuations in the market than we have as well. And I think to Santosh's point, you've had a number of factors that have pushed out the timeline for this type of IPO cycle, which really picked up last year again, whether it's availability of capital, compliance rules. But I think the batch of companies that are coming to market are not necessarily in desperate need of capital. You're much more refined. And so I think this is more of a natural cycle.
So what do you think about that, Santosh? The fear of missing out, to what degree is this all about FOMO?
No, for these companies to come to IPO, not necessary. I think one thing I want to just add is these companies are coming with tremendous leverage. They're flush with cash. They're not desperate to do an IPO. They can wait it out if needed. So they're going to be very opportunistic. Right now, like I said, the models are very mature. And there comes a time in a private market cycle where the risk reward is much favorable when you're a public company. So you need to go out for the next leg up. You need to capture that incremental growth, expand outside, buy growth rather, keep on to talent, and that's becoming increasingly scarce in the Silicon Valley. So I think all these things are better off as a public company than that. So they're getting out there with a very good leverage behind them. They're not desperate. So I think that's a big difference between past and present.
But this space is huge, and the food delivery service space could be even bigger, but ultimately the likes of Amazon want in, the likes of Uber are in there and growing aggressively. Who's got this right, and how many players can coexist?
Well, right now I think there's room for all. It's not a zero-sum game, so you just have to, it depends on what contracts you get, like Uber Eats has McDonald's and Starbucks, and Postmates has these big ones like Walmart and all the other ones. Yeah. So I think all depends on relationships. It's open season, it's land grab situation in the market, so every company's out there. So there's enough room for all of them at this point. So we'll see how it settles in the end, but there is room for more.
Santosh, always great to get your insight on this particular topic. It's really important. He always comes back to us and keeps us up to speed. Santosh Rao and Keith Parker, a special thanks to you as well, sir. Coming up on the market moving events you need to be watching right here in this program. That is next in our trading diary. And the markets right now, 22 minutes into the session. Equities just a little softer, down 0.5% for your third straight day of losses. This is Bloomberg.